Hello and welcome to another episode of Monday Markets. As always, we're brought to you by Woo. Links available in the description below. Do not keep any more funds than you need for trading on any single centralized exchange, whether it's Woo or somewhere else. That's the whole point of leverage. You get to use it to reduce your counterparty risk and be able to trade your normal trading sizes without having your full collateral on the exchange. If that still sounds interesting, please read our long form article and then consider signing up via the link below to support the show. So let's get straight into it. First things first, as a final housekeeping note, I should say, thank you for all the kind comments on the last Technical Roundup Casual Friday episode. I really appreciate the feedback. We're glad this channel has been helpful. We appreciate that we're not the most entertaining or biggest or best edited or flamboyant channel, but we just like to share our views and try to do it without fear or favor and as objectively and as reasonably and accessibly as possible. And it's nice that even in this in these unattractive conditions for centralized exchange traders, that we have so many of you listening to us and leaving us feedback, comments, etc. We do appreciate it and thank you, and hope we can keep providing this valuable entertainment, service, analysis, whatever you want to call it. So enough talking, let's do the thing that you are here for and talk about the market. I'm not going to spend too long on the monthly, but I do want to bring it up. So if we look at where monthly support is, the eye is drawn towards the prior levels at 23k as the earliest, and then if you want to get really spicy with it, 20k as the sort of final level. Now, we're not near that monthly level of support, but I do think there is a relevant level for our purposes that's slightly closer to the market. If we take this lowest close on the monthly, that was basically the range before the ETF month and that entire reversal, we have 10 days left in the monthly close. I think it looks rather likely, without counting my chickens before they hatch. Is that the idiom? I don't know. English is hard. But nonetheless, it looks like, unless we get a very impressive reversal in the next 10 days, that we're going to close the monthly below this 27.2 level. And if we do, I think it would indicate a subtle market structure shift on the monthly by making a lower low close relative to the last low, and would indicate a push towards lower monthly levels of support. So I think there is some useful context in the monthly. We are still far from the levels. You're not getting pure kind of level confluence on this time frame, but we do have a near-term pivot, I think, at 27.2 that's going to be somewhat useful. And the main reason for that, let me just jump to the daily before we do the weekly, is that if we look on the daily time frame, this 27.2 level ends up being quite technically significant. So if we go all the way back to this daily cluster, which I'm sure you'll recall us covering in depth at the time, in any case, it sort of lands around this nice 27.2 inflection point. We had a range high, stab above, range high again, that type of important range trading level here, broke above it, continuation, and now we're back down below. I generally, like Don, quite like when levels get sort of completely, levels that are self-evidently important get smashed in one direction and then smashed in the other. If you go back to some very old CryptoCred videos, there's one about the clean double close and how I think sometimes that's a signal the level is actually very good and not that it's washed up. For me, washed up levels is if the market just starts trading around it both ways and is essentially insensitive to the level itself. But if the level has in the past proven itself to be quite pivotal, and then you get volatility based around the level on the subsequent occasions, that to me is still a valid level. So we know in this instance that not only is this a monthly level of resistance, but we have very good daily confluence here, regardless of which specific anchor you use, whether it's this daily cluster here or this range here, all of the signs point towards 27.2 being significant. So that's an important thing to bear in mind. We'll come back to it when we cover the daily time frame. As far as the weekly goes, it's, still, it looks quite bad, right? And even without reference to levels, contextually speaking, we have this entire period of historically kind of all-time low volatility, and then that volatility has chosen a direction, and that direction has been to the downside. So you must, or at least I am assuming, that is a trend-forming break. If we cast our minds back to the bullish arguments being made at 30k by some commentators at the time, and I'm not slighting them or saying they were wrong and I was right, I think these were quite reasonable arguments. But the argument essentially was that historically low periods in Bitcoin volatility have always, or on average and generally, preceded moves higher. And so the implicit argument there is that when you have low volatility and the market finally breaks from that low volatility into higher volatility, there is continuation in the direction of the break. Now, that argument was used in the bullish direction, but I don't see any compelling reason as to why it wouldn't apply in the bearish direction as well. It's the same mechanism, right? Low volatility shifts to high volatility, continuation in the direction of the shift. And I think that applies to the downside as well as the upside, which is why, as per last week's video, one of the arguments I made was that, if this breaks, don't catch knives too early. Let this thing go. It's likely going to have more steam, especially because that shift tends to be violent, and that's pretty much exactly what we've seen. And this move looks outrageously large, and it is, and even in open interest terms, it was a huge move. But on the weekly time frame, if we're dealing with 2 months of volatility constriction, we've only really had 1 week of volatility resolution, and I think it's quite reasonable to assume that there are good chances that there are more weeks to follow in that direction. Okay, at the very least, I should and I am skeptical about any medium to high time frame trades that essentially assume that just because this move was big, it's just going to revert higher now and that was it. It's going to keep going until proven otherwise. I'm going to assume that this weekly break and the shift from low vol to higher vol is trend forming and not some mega capitulation thing. Now, of course, that's not to say that the very next week looks exactly like the vol forming, the trend forming week. But just in terms of general directional bias, I kind of take this stuff seriously, for lack of a better term. So where are we left on the weekly time frame? Well, we know the monthly has this magnet, if you will, or the nearest support at 23, 24K. We can find a weekly confluence there, with some of these former range high levels. But given this is a weekly show, it's worth asking, where are we right now? So I think a couple of levels matter. The first is this weekly range low here at 25.9 or 26K. This is one I also tweeted. And this is sort of definitely a local extreme. So if you're going to get, if this move essentially is going to fizzle out and continue lower, so something like trend forming big candle, consolidation, weak bounce into continuation, my expectation is that the bounce must come from in or around this level at 26K. Anything else just looks too breakdowny, and if we sort of continue through this wick, it'll probably speed up. So if you're making arguments for any type of consolidation or counter trend bounce, I think they have to be made from around 26K or thereabouts. Now, this is where the daily time frame becomes relevant again, because if we can see that this is, a weekly extreme of some sort, and the market doesn't seem to mind that idea, the problem is, where is that first trouble area? And this is when, once again, we go back to our monthly and daily confluence of mapping out the 27.2 level. And this essentially creates our trading range. So I think if you want a reasonably helpful market roadmap for the days and potentially weeks to come, I think unless the market just continues very aggressively lower from here, and you're just looking for shorter to medium term anchors for price action after a move like this that just chops through a bunch of levels, or slices through them rather, I think you can do quite well with these. So 26K as the local maximum, and 27.2K as the very important resistance level that's above us, and you can always carve out a midpoint for a short-term pivot as well. That's what makes sense to me. My base case, again, continues to be that this breakdown is trend forming until proven otherwise, and that any bounces, especially bounces into 27.2, will be met with resistance. The natural caveat or proviso to that is that if we get really positive ETF news, especially in this kind of low liquidity, low depth state, it's quite plausible that the market sort of wicks or at least pushes through those levels with more ease than it ordinarily would. Of course, conversely, that applies to the downside as well, such that if the ETF news is bad, I don't think we'll spend any time in consolidation and probably start dive bombing towards these lows and those aforementioned monthly levels. But absent that, this makes sense to me as far as 26 to 27.2. If we go down to the 4-hour, we can find further support for this argument with reference to one of the really old ranges that we had here. Some of you will remember this, between 26.3 and sort of 27.4 as a range. So again, we see that 27.2, 27.4, that area is sort of relevant on all time frames. So at the moment, we don't even have the luxury of trading above that range low. So I think this level is fairly self-evident. You had a low, failed break, low, support resistance flip. And I think ETF news came out like here-ish. And so the market blasted this level and then really started to pick up steam. This is good enough for me as far as an anchor. It does qualify. So how do we use this with the context of everything that we said? I think there are a couple of ways. Diddling in the middle could be acceptable for short-term trading, just because we have some nice sort of wicks built up here. That might be interesting. But the two ideas that make sense to me more, or the ideas that are more compelling, sorry for the terrible English, are essentially the following. One is taking a fade of some sort at 27.4 / 27.2. We know that's a monthly level. We know it's a daily level. We know it's a 4-hour range high. So all your sort of normal entry triggers for range high resistance would make sense at 27.4. There's a ton of confluence there. As far as 26.3, I think you could trade this level both ways. If you're really desperate to be bullish and you're looking for a counter trend bounce, I think the earliest evidence of that you're going to get is above 26.3. And the reason for that is, if we look at this on the 1 hour at the moment, there just isn't a whole lot going on. You know, you had the capitulatory move, a mechanical bounce, and then just lower high from there, lower low arguably, and then we entered a really narrow trading range here. So at the moment, there isn't anything terribly compelling, but you can start to see that if we get above 26.3, you know, above here, if we look at what that might, how that might transfer on the hourly time frame, you'll have a reclaim of a 4-hour range and an hourly break in market structure. So at least it's something. You know, this is like day trading, getting in the weeds type of ideas, which some people asked for, more so than the stuff we cover on the weekly show. But if you're looking for bounce arguments, I think your first and earliest argument will come above 26.3. Now that comes with the issue with this. I think 27.4 also works this way, but more with 26.3, is that if you try to basically breakout trade this or range trade this higher, and the market just puts in a high here and falls, you know, back below the level, so you get something like an overshoot, you think it's a reclaim and then it's back below, I actually think that'd be quite an attractive short. So in terms of using these 4-hour, 1 hour ranges, in terms of the trades that I think are most compelling within this structure, they would be at the extremities. So either a reclaim or a failed reclaim at 26.3 as a near-term pivot, or if the market really rallies, 27.4. This to me makes sense. Diddling in the middle could be acceptable, but I'd rather do business at the extremities. Where the market is right now is nowhere, essentially. So I think, you know, if you miss this move or you're just kind of itching to trade and feel opportunity in the air, I think 26.3 to 27.4 provides a better than average range in which to do business. And my preferred setups would be failed breakouts in those ranges, because that aligns with the higher time frame directional bias of the market breaking down and not being at support. So failed reclaim of 26.3 I think is attractive, up to 27.4, so I think similar would be attractive. Everything else has to be much more short term, maybe level to level if you're looking to get long. But in any case, you know, I think I've made enough educational videos about entry triggers and top down trading and all that type of stuff for you to know how to navigate these. So I don't want to lose the high time frame picture too much. We are at a local extreme on the weekly, but the context sucks. And the context sucks because we consolidated for ages, had historically low volatility, broke down from that, and I take that quite seriously. Any bounces I expect to be met with resistance, and the better candidates for those resistance are around 27.2, 27.4 or thereabouts. And we've just extrapolated those to the lower time frames to see if we can squeeze water from this rock in the interim. I still think the proviso that we outlined, Don and I outlined on Casual Friday makes sense. The ETF news will probably accelerate things very aggressively if and when we get it. So I also think that if you're going to be trading this, I would not be doing it with sort of set and forget limit orders. I'd want to be at my desk to try to make sense of the technical levels and the news that is coming with it. So hopefully that's helpful. If it's too low time frame, just let me know in the comments if you kind of got lost in the weeds or if that wasn't helpful, and I'll skip it. But I thought maybe a full multi-time frame overview would be helpful. As far as ETH goes, I'm not a fan of the monthly here. You know, you could make the argument that this is a monthly range high, but historically it really hasn't done much. So for example, this breakout, so this is one of those levels that's quite deceptive. It looks like it's super useful, but it's not really. So if you look at how price has behaved around this level, I mean, it was good resistance initially. So granted, that is, that's when it was last useful, I would argue. But then if you took the breakout trade on the monthly, that really didn't sort of get you anywhere, right? And then if you took the retest trade on the monthly, it didn't really get you anywhere either. So, you know, if that's how the market's responding to the level, I'm not going to be super fond of it. If the monthly closes back below, I mean, that would be not great, but I wouldn't just put too much stock into this monthly time frame. So that's just that. As far as the weekly goes, ETH is at least reaching some interesting areas. So again, with BTC, we've noted that it's in this weekly extremity of some sort, okay, something rather than nothing. I think you can make a similar argument with ETH. You'll recall the way we used to splice this up, which was to take this narrow range between 1.9 and 1.4, extend it, and then we'd get like an interim midpoint at 1670, 1700 or thereabouts. The market is sort of there. Obviously, depending on which exchange you use, got different wicks, different closes, etc. But at least we're somewhere remotely relevant. Just like for BTC, like, is this lowest close a particularly good level? No. Is it remotely relevant given we're dealing with huge OI wipeouts and doing business at extremities? Yeah, I think it's better than nothing. And same sentiment towards ETH. Is this the best level? Absolutely not. Is it something rather than nothing? I'm willing to make that argument, okay? But really, that's where the clarity stops as far as ETH goes, because the daily time frame just hasn't been so great, and I don't want to superimpose my view on the market. Even on the 4-hour and hourly, there's just kind of the structure there is sort of lacking. You know, with Bitcoin, at least we could make multi-time frame arguments for 27.2, 27.4. We had clearer 4-hour ranges to do business in, to sort of anchor our low time frame views to something a bit more significant. I don't think we have that luxury for ETH. So that's essentially where my ETH views stop. I think if we start to push lower, we get better levels and clearer supports, and contextually would make more sense that, you know, you've had the wipeout candle, some consolidation, and then the real ugly push deep into support. Those types of setups I really like trading. But now that we've had the kind of blow up wick and we're in the low volatility chop that follows, that typically doesn't lead to the best trading conditions, in my opinion. So I'm not going to burden you with ETH views that I don't hold or believe in. And ETH BTC has basically been at the same price for many weeks now. You could make an argument of some sort of bullish engulfing here, but I think that's just way too technical. And bigger picture, it's still more or less in the same daily range, so not a whole lot going on there. Legacy, not helping, to be honest. You know we have the macro duck back on board, popular with exactly nobody, but it is true that this has been a headwind. As far as the high time frame closes, this is a bit of a murky one, because it depends on whether you want to use this kind of lower high structure as your support, in which case that's been retested and is holding, or if you want to use 4,300 as the extremity, in which case that hasn't been reached. I don't think it's entirely clear at this point which one is more valid. What I will say is that on the daily time frame, when we first marked out the shift in market structure here, it's been pretty aggressive continuation since then. So I'm slightly cautious of that. It'd be nice if this basically stopped being so steep and maybe based out a little bit, and we can make better trading decisions in this context. But at the moment, this is pretty steep, and that's not great. You know, you could look at how steep a trend is to try to infer its strength to some extent, and it makes shifts in market structure slightly more identifiable. But the only reason, realistically, we look at the S&P is to see if it's a high time frame support or if it's going to potentially help crypto. Even when the S&P has been at high time frame support, it hasn't helped crypto, so I'm just almost paying lip service to this thing. But it hasn't been particularly helpful for the bullish side. And on the bearish side, you can make arguments there, but we are at least approaching some sort of reasonable first trouble area between 43 and 43.70. The only question is whether it bloody helps us or not. If you were to ask me colloquially where I think this thing is going, I think there's a decent odds of a bounce from 43 to 44, but I really wouldn't be surprised if we push back towards the monthly 41, and that certainly wouldn't help the crypto side of things. I know this analysis has been a bit bland. I mean, altcoins are getting completely battered right now. That's not terribly surprising. In many cases, when you get these sort of blow-off events, you get a mechanical bounce because the order books are empty, and then the thing just, the asks, as Don likes to say, walk down, and the thing gets repriced pretty quickly. And that's more or less what we're seeing. There's also a partial BNB liquidation with one of the DeFi protocols, I think. I could be completely wrong. I saw something like that and I didn't pay too much attention. This is a scary looking chart with this multi-year support. I don't like it. I don't think it's great for risk appetite in general. And yeah, the rest of alt's a bit of a mixed bag, but mostly red, not a whole lot going on there. However, before you click off, I thought I should do another quick sort of educational thing. If you find this kind of stuff helpful, let me know, but more on sort of futures and looking at this type of data. So you'll often hear commentators and traders and analysts talk about reclaim setups or divergences or trap delta or whatever. And the basic logic for all of those types of setups is that the market is trying really hard to do something and it is failing to achieve it, right? So, for example, a failed breakdown is that the market's trying to trade lower, or it's attempting to break it down, or to break down rather, not break it down in any kind of breakdancing way. But the market is attempting to break down and it is not successful in doing so. The same with basically a lot of footprint charts. You see like a burst of delta below a low, a lot of market orders piling in, and then let's say they go nowhere and the market trades above that cluster of delta. You could reasonably infer that those participants who tried to be aggressive are trapped, and then the market will squeeze them and lead to your reversal. Now, one of the reasons that on this channel, at least, we like to talk about waiting for good evidence of a reclaim or a failed break is because the alternative is kind of what we see here, right? So if we look at this chart, and it applies for both BTC and ETH. So what you see here is, I mean, this is the price chart. This is the open interest. This is the cumulative volume delta with spot and perps. And this is not relevant for our purposes, just the liquidations, right? So a lot of the time, even if you're just looking at this from pure price action perspective, but certainly with indicators, you want to see some divergence between who's being aggressive and how the market is treating that positioning. Now, in this instance, what we can observe before the drop, and there were some really good sort of lower time frame traders who are pointing this out, is the following. So we see price pretty much, you could start either sort of at this leg, but I would argue it starts even earlier, sort of from this high onwards. Generally speaking, doesn't need to be precise, you have price making lower highs and lower lows. And at the same time, again, depending on exactly where you anchor, you have a general increase in open interest. Now, the final sort of piece of the puzzle here is that at a certain point, the CBD, which is basically market buys versus market sales, and that they really start to sort of steepen and pick up, you know, the negative delta, essentially, both on spot and on perps. And so what you can essentially infer from this, and it is infer, not deduce, because there's a lot of sort of probabilistic guesses that go into trying to figure out how directional open interest is. And I can make another tweet series about that, like for the open interest and liquidations one. But essentially, the market is following the aggressors. So open interest increasing means net positioning is increasing, price is moving lower, and you have CVD starting to not cross significantly negatively, but sort of, you know, for our purposes, we can say something like trend lower or break lower, or, you know, whatever term you want to use. So those three pieces of sort of medium strength evidence can lead you to a decently strong conclusion that these sellers in the market are being aggressive. Price moving lower, they're expanding their positioning, and we get to infer the direction of that aggression with more accuracy, given that the CBD, both on spot and perps, is also marching lower. So aggressive shorts for all intents and purposes. Now, if you're going to be looking for bullish arguments or making arguments for divergence or absorption, one of these needs to be wrong. So for example, if you have an open interest increase like this, and the CBDs are delta is significantly negative, but price, for example, starts to stall out, you can make a bullish argument that, hey, there's a divergence. These guys are being really aggressive, but price is not rewarding their efforts. And if it starts to push up, we can then infer that that aggressive positioning is going to be trapped and is privy to being squeezed, which would result in a move higher. Same applies for the ETH chart here. You know, sort of uptrend. And I'm using these terms very liberally. I'm sure some experts will be very upset, but you know, this is just for pedagogical reasons anyway. You know, general increase in net positioning via the open interest, price marching lower at the same time, and I mean slightly less clear in this instance, but lots of sort of negative delta being put in as well. But most importantly, you know, the whole point of this exercise is there's no divergence. The market is following through, and you can tell through, you know, using that to create, what am I trying to say here? You know who's in control. There we go. That's probably the simplest way I can put it. Like, who is in control? These guys are increasing their net positioning. We know that they're more likely than not to be skewed directionally, given what CVD is doing, certainly on the BTC side, and price is following along. So there's no trap, there's no divergence, there's no disorder. Everything is sort of, they're being rewarded for their aggressive selling efforts. So essentially, when looking at any of the kind of futures data stuff, footprint stuff, or whatever, you have to answer a two-part question. One is who, if anyone, is being aggressive? And two, are their efforts being rewarded? If the aggressors are being rewarded, then just follow them along or don't fade them. If the aggressors are not being rewarded and price is diverging or open interest, you know, is flinching if the market moves in the opposite direction. But ideally, you just want to see evidence of aggression via open interest and CVD, and price not playing along. So who's being aggressive and are they being successful? I think that will lead you to very fruitful paths of inquiry, especially if you add open interest to that. You can really start to make a nice cocktail of confluence. That's all I've got time for. I know that was a bit rambly and I completely lost my thought in the middle of that. I do apologize, but I hope that was helpful nonetheless. If it was, leave a comment. As always, thank you for watching the show. Thank you to Woo for supporting the show. Links available in the description below. Have a wonderful start to your week, and we'll see you for the newsletter tomorrow, trletter.com. Goodbye.